Hello, everybody. So glad that you're joining us today. This is Sally Ganga from Bright Horizons College Coach, and we are doing the Getting In podcast. I'm really excited about this show today because my old boss, Ted O'Neill from the University of Chicago, is going to be on for our second and third segments. He'll be giving us a nice retrospective of his career and the kinds of changes that he's seen during that career, which started in 1980. But first, we're going to hit the really practical side of things. My colleague, Laurie Peltier, is here, and she is going to be talking about understanding education tax breaks. So Laurie, thanks so much for coming on the show.
Hi, Sally. I'm happy to be here.
All right. So I have heard that you might be able to get a tax break while you're paying for college. Is that true?
Yes, you heard correctly. You may be able to, but you have to qualify. As with many tax breaks, you have to meet certain qualifications. There are 2 tax credits that people can take while they're paying for college, and then 1 tax deduction that you might get when you're paying back your educational loans. But in order to qualify for any of them, you have to have income below a certain level. You have to have paid the right kind of expenses, and you have to have had the right kind of enrollment for the student. And these tax breaks that we're talking about are on your federal income tax forms. There are a few states that have some tax breaks for education. So check with your state when you're filing your state taxes as well.
Okay. So that all sounds pretty complicated, kind of keeping track of what you qualify for and what you don't. What is maybe the most common tax break, and what might you need to qualify?
So the most common and the most generous tax break is called the American Opportunities Tax Credit, or abbreviated the AOC. If you're married filing jointly and have adjusted gross income below 180,000, or if you're filing single and have income below 90,000, and you paid tuition and fees for a dependent on your tax return, you might qualify. Many people I speak to either earn too much money to qualify for the tax credit, or they might be in a divorced family situation where one parent is claiming the student, but the other parent is paying for their tuitions. So when you're filing your taxes online, if you're doing it yourself, you'll look for questions about, did you pay tuition last year? Are your dependents enrolled in college? So it will prompt you to answer the questions to get the credit. And of course, if you have an accountant helping you with your taxes, you would want to provide them with information about the expenses you paid for college.
Mm-hmm. All right. Are there certain documents that you would need to submit to prove that you paid tuition?
Yes, the document you would get is called a 1098-T. The 1098-T comes from the college, and it documents how much the student paid in tuition and fees in the previous tax year. So if you had a student enrolled in the fall of 2021, check with their college to see when the 1098-T is going to be released, whether it's going to be mailed to the student or whether you can download it from the college website. But it would give you all the information you needed about the student's enrollment status, whether they were full or part-time, whether they were an undergraduate or a graduate level student. And it would then be able to be shown to the accountant to say, see, I qualify for the tax credit.
Mm-hmm. Okay. And so I think there's some tax breaks that are more generous than others. So how much are we talking for this last one?
Right. So the AOC is pretty generous. It's $2,500 in a credit. So that means it reduces your tax liability by $2,500 or can increase your refund by $2,500 if you've paid up to $4,000 in tuition and fees. So it's a percentage of what you've paid. So depending on how much you've paid will depend on the credit, but $2,500 for each child that you're paying tuition and fees for can really be helpful. The other tax credit that's out there that you might hear about is called the LLC, or Lifetime Learning Credit, and that one is a maximum of $2,000. So most people try to get the AOC first, and if they don't qualify for that, then they try to get the LLC instead.
Mm-hmm. And how about educational loans? I hear there's a tax deduction on those as well.
Right, and it's just on the interest that you've paid on your educational loans, and it is only for families who earn a certain level of income. So the income cutoffs for the student loan tax deduction is a little less than the AOC. So your income, if married filing jointly, is 170,000 or less, or if you're a single, filing single, it's 85,000 or less. And the maximum interest you can deduct is $2,500 per year. Your payments towards your principal on your loan don't count. It's just your interest payments. So again, the student will be notified by their loan servicer of how much they paid in their interest on their loans in the previous year, and that's how they will get the credit.
Okay. And can the parent take the student loan interest deduction?
They can if they are the borrower on the loan. So if the parent borrowed or co-signed with the student, then and paid, made payments towards interest, then they could take the credit if they fall under those income restrictions. But if it's a federal direct student loan that the student borrowed, the parent can't take the credit for that loan because that one is in the student's name and responsible, the responsibility of the student.
Okay. Any last minute advice for people who think they might qualify?
This gets a little tricky, but just something to be aware of is that if you're paying for your tuition and fees with a 529 plan, as many families have saved in 529 plans, which is a investment that gives you some tax breaks as well, and you qualify for the American Opportunities or the Lifetime Learning Credit, you have to manage your withdrawals from the 529 plan because the government doesn't allow you to double dip, to pay your tuition and fees with the 529 plan and get a tax credit on those same tuition and fees expenses. So check with your tax preparer and see if you qualify for any of these credits, and then try to pay some of your tuition and fees out of pocket or with a loan so that you can take the credit and not pay it 100% with your 529 plan.
Okay. But in general, I'm guessing you'd still recommend 529 plans for people. This is not a reason not to save.
Exactly. You're going to have enough expenses,
Yeah.
and most people don't have enough in their 529 plan, so it's not an issue. But I do meet families who, they have the money, they want to use it 100% their freshman year. You might be better off not draining your 529 your freshman year, paying some out of pocket so that you can take that tax credit because it is pretty generous.
Okay. All right. Great. Laurie, thank you so much.
Oh, you're welcome. Happy to be here.
All right. So we will be returning in just a few minutes, and I'll be talking with Ted O'Neill about his career in college admissions.